I am wearing the bull market socks. The Bitcoin bull is back, baby. And I'm not ready to call it absolutely, but if we surpass 21.9 on this kind of third rally, we've made 3 successive higher lows off the 17.5 wick. And I'm starting to feel like spring is coming. They said, well, there's not a hedge against inflation because inflation was 9% and Bitcoin didn't go up. I'm like, oh, wait a second. In the last 2 years, the Fed, this big spike on the chart, the Fed printed 50% of all the dollars in the history of the Republic, 256 years. Oh, interestingly, if you print 50% of the dollars, that means you basically devalued by 100%-ish, right? Because you've doubled the money supply. Bitcoin's up precisely 100% in that 2-year period.
Mark Yusko, an American investor, hedge fund manager, and Bitcoin bull, believes we are at the end of the Bitcoin winter and gradually approaching a massive summer period. Yusko is the founder, CIO, and managing director of Morgan Creek Capital Management, a firm that caters to pension funds, endowments, and wealthy individuals. In a recent interview, the veteran asset manager gives his outlook on Bitcoin and the traditional financial markets. For Bitcoin, Yusko predicts an upcoming rally. He also establishes that prices are not as bad as we believe. He bases this assumption on the dollar devaluation caused by the Federal Reserve's excessive money printing during the pandemic. When the central bank prints more money without a corresponding increase in the production of goods, there is more money to chase the few available goods. This means prices start skyrocketing and the dollar gradually loses its value. According to Yusko, this devaluation of the dollar has brought down the price of Bitcoin, not its actual value. On the other hand, the former senior investment director at the University of Notre Dame believes traditional asset classes, especially the stock market, will have a very hard time getting back to a bull market. He compares the situation with the stock market with the dot-com bubble and points out the many similarities between what happened then and what the market is experiencing now. This interview promises to be an enlightening one, especially from the macro point of view. So ensure you watch it to the end, hit the like button, and drop your comments and observations in the comment section below. Without further ado, let's dive right in.
On the positive side, when you have higher lows and higher highs, and because markets chop, right? Markets don't go straight up, they don't go straight down. They chop because human beings react to greed and fear. And there are 2 types of markets. Winter and summer are distribution markets, when people are selling, distributing, and accumulation markets, when people are buying. And signs of accumulation are when you get a low and then it starts to go up and then people get afraid and they start selling and it pushes back down. But then there's more buying pressure, so it doesn't go as low. So you make a higher low, and then you go up again, and then you start to come down, and then you make another higher low. That pattern of higher lows is the formation of, you've heard it called a bottom, a rounding bottom. And if again, people say, drawing lines on charts doesn't do anything. No, it doesn't predict things. It doesn't cause things, but it lets us see patterns of behavior. So again, it's not about prediction precisely. It's about directionality and pattern recognition. And it's just because human beings.
Yeah.
The key thing, I sent a series of tweets yesterday about this on the traditional market and then relative to the Bitcoin market. The traditional market, not done. It's got a long way to go. And the problem is too much leverage, right? There's still a massive amount of leverage. We corrected the amount of leverage that was higher than 18, which is orders of magnitude higher than 2008. There's so much margin debt in stocks that needs to correct. And as it corrects, the problem for stocks is stocks are still 54% overvalued relative to fair value. They've only been this expensive 7% of the time. In all of history, 140 years of history, only 7% of the time have U.S. equities been more expensive than right now. That includes the drop this year. On the flip side, Bitcoin has only been cheaper than its long-term history on 2% of the time, 2.5% of the time. Stocks go up. Over the long term, stocks go up. Why? Inflation, right? Our currency gets less good, so the value of assets goes up. Earnings, right? Companies actually earn money. And growth, right? There is economic growth. So those three things make that red line go up about 6% compounded in real terms a year. And the problem is stock prices reflect greed and fear. And the greed is when we're above the red line, and the fear is when we're below the red line. And you can be above or below for a long time, but we've been above for a very long time. And to get back to fair value requires 54% drop from here. It's crazy. This is not PE like today.
Yeah.
This is called PE 10. This is 10 years of average earnings, which smooths the peaks and the troughs. And people are saying, the PE should be higher because companies make more in a low interest rate environment. Yeah, that's a specious argument because low interest rates are a sign of economic weakness, not strength. And so your future earnings growth is probably lower. But if you take a 10-year cycle,
at the beginning of the pandemic in March 2020, there was a sharp drop in the U.S. stock market, but the recovery was even more dramatic than the drop. By the end of 2021, the stock market was up almost 50% from its pre-pandemic level. With the record high inflation and interest rate hikes, it has given up some of those gains in 2022. If it loses all those gains and possibly more because of the current macro environment and geopolitical tension, there could indeed be a bigger drop within the next 6 or 12 months. In his interview, Yusko compares what we are experiencing now to the dot-com bubble in 2000. He adds that since 2000 was just a warm-up for the final bubble burst, we can expect the same chain of events now.
This is 2001 redo. And, I've talked about this and talked about it ad nauseum. People forget 2000 was not the bad year, right? 2000 was the warm-up. 2000 is when people went, oh, wait a minute, this is stupid. And we started to go down, but then we had this relief rally where the Fed said, we're going to save everyone and we're going to print more money because the Fed had printed $500 billion, one half of a trillion, not 10 trillion. But when the world didn't end, people looked at stock prices and went, oh, geez, these are pretty high. And so March 24th, that was the top. But then the Fed came back in that first quarter of 2001 and said, no, we're going to provide liquidity and we're going to save us. And so we only ended up down 6% for 2000. But 2001, when Stan was getting whipsawed, was you had this rally. And we went all the way back almost to equal from, I think at one point down 14, 15%. So it was a vicious rally from kind of the middle of November through December into January, February. And then the stuff happened. All the stuff that Stan describes led to earnings revisions. So famously, and this is also happening right now. So you had these companies like Cisco that couldn't sell their inventory. So they wrote it off. And literally, then they started selling it again later at zero cost, which is just so insane. But they wrote it off and they said, oh, we have to restate all of our earnings from the last 5 years because we kind of exaggerated. And it led to the discovery of fraud. 2002 was the really crappy year, right? That was down 22. And so you still had plenty of time. And if you look at a bubble chart, at a traditional bubble chart, and you can maybe attach it to the show notes, it goes and has that false bear trap where it kind of falls. And then it kind of goes parabolic to the top, and then it rolls over. And then you have the last cathartic kind of turn up, and it's called a return to normal. As everybody says, no, it really is a new paradigm, that term new paradigm, which anytime someone says that, just run away. And then you have the drop, and the drop accelerates through capitulation and fear, and then you get to loathing on the other side. And if you remember first quarter 2003, right before we invaded Iraq for the second time, that was when people were like, I'm done with stocks. I'm done. I never want to see a stock again. Institutions were like, we're not going to invest. And that was clearly a good time to buy them. That and war. War. We have war too. I mean, everything's the same. I was making the case that Bitcoin is a good asset. And these people, we are so early, Michael. These people, like one woman came up to me and said, I disagree with everything you said. This is a Ponzi. I'm like, well, look, if you don't know the difference between a Ponzi and a pyramid scheme, then we can't even have a conversation. Because by definition, it is not a Ponzi. Not a Ponzi. You can call it a pyramid if you want, just like any other currency in the world, which is built on faith and belief and foundation. But you can't call it a Ponzi. But this audience wanted nothing to do with Bitcoin. Now remember, this is Pacific Northwest, this is Amazon and Microsoft, and we're rich because we're smart, and they want to have nothing to do with anything. But what I said is, they said, well, there's not a hedge against inflation because inflation was 9% and Bitcoin didn't go up. I'm like, oh, wait a second. In the last 2 years, the Fed, okay, this big spike on the chart, the Fed printed 50% of all the dollars in the history of the Republic, 256 years. Oh, interestingly, okay, if you print 50% of the dollars, that means you basically devalued by 100%-ish, right? Because you've doubled the money supply. Bitcoin's up precisely 100% in that 2-year period.
Meanwhile, another bout of the crypto market's infamous volatility has brought Bitcoin below $23,000 for what seems like the 10th time in just a week. As of press time, the world's largest crypto asset is trading at $22,297, a 5% decrease over the last 24 hours. The price decline has also affected other top cryptocurrencies. Ethereum has fallen by over 7% and is now trading at $1,522. Solana, Cardano, XRP, Binance, Polkadot, and Dogecoin have all lost between 5 and 10% within the last 24 hours. The overall crypto market, which only just got above $1 trillion, could go under again if the decline continues. This latest decline could further weaken sentiments and send prices tanking again. What do you think about Mark Yusko's interview and the latest price decline? Do you think we get another bottom or a brief drop followed by more consolidation? Please drop your comments and observations below, and don't forget to like this video. Thanks for watching.